Welcome back to The Explainer. Today, we're doing a deep dive into a complete company formation and offshore structuring overview. Specifically, we're zooming in on literally one of the premier vehicles for asset protection in the world, the Luxembourg SARL. If you're an international business owner or maybe an investor looking to diversify your assets across borders, this is a structure you absolutely need in your toolkit. We're going to break down exactly how it works, why it's so incredibly popular, and how you can leverage it for top-tier global protection.
Here's our executive briefing for today. We'll start with Part 1, what exactly a SARL is. Then, Part 2, the key advantages. Part 3, we'll look at corporate features and privacy. Part 4 is all about understanding the tax system. And finally, Part 5, the actual requirements for incorporation. Let's get right to it.
Okay, let's dive into this. Section 1, what is a SARL? We really need to pin down exactly what we mean when we throw around this acronym. To truly grasp the massive impact of the SAR, you literally just have to look at this one number, 60%. More than 60% of all companies in Luxembourg are SARs. It is hands down the most common and trusted corporate form in the entire jurisdiction. And honestly, it's the go-to choice for a very good reason, perfectly blending deep historical roots with modern financial agility. So, SARL officially stands for Société à Responsabilité Limitée, basically a private limited liability company. Now, the legal framework for this actually dates all the way back to the Luxembourg Civil Code of 1915, but the reason it is so powerful for us today is that it acts as a hybrid structure. It's explicitly designed to give business owners the absolute best of both worlds. And this brilliantly illustrates that hybrid nature. On the one hand, you get the corporate shield, right? Your liability as a shareholder is strictly limited to the capital you've actually contributed. Your personal assets are totally walled off. But on the flip side, you don't get bogged down by the administrative nightmare of a massive corporation. You get the simplicity, the increased flexibility, and the tight control of a private partnership. For example, shares can't just be freely transferred without approval, which really keeps your controls securely locked in. All right, moving right along. Section 2. The key advantages. Let's talk about the specific real-world benefits for an international business owner looking to expand and diversify offshore. The perks here are absolutely robust. Beyond that limited liability we just talked about, the ownership flexibility is a huge draw. A SAR can actually be set up with just a single shareholder who keeps 100% of the rights and control, though, you can go up to 100 shareholders if you need to. You also secure a notoriously high degree of privacy because shares and shareholder names just aren't publicly listed. Plus, you're in Luxembourg. You've got Germany, France, and Belgium right next door, giving your company prime, frictionless access to European Union trade opportunities. But what's really wild about all of this is the barrier to entry. Setting up a premium European corporate entity sounds like it would cost an absolute fortune, right? Well, the minimum authorized share capital to establish a Luxembourg SARL is only 12,000 euros. That is literally less than the price of an entry-level used car. And you're getting a world-class corporate entity. So, the crucial point is this. Luxembourg operates on a territorial tax system. This means that for foreign-owned businesses, only the income earned directly within Luxembourg is subject to local corporate tax. Let me say that again. If your SARL is generating income entirely outside the country, that foreign-sourced income avoids local corporate taxation entirely. This is exactly what makes it such an ideal, legally compliant offshore setup. Okay, let's get into the mechanics. Section 3, Corporate Features and Privacy. Let's see exactly how this jurisdiction protects your identity and your operations. Here's some fast facts on the corporate framework. Luxembourg uses a civil law system governed by the Companies Act, which got a major update back in 2016. You do need a local registered office, but you don't actually need a local registered agent. Also, notice that bearer shares, those unregistered anonymous physical stock certificates, those are a no-go. Everything has to be registered. And check out that last detail. The fixed government registration fee to incorporate is just 75 euros. Crazy, right? Now, despite having to strictly comply with European Union standards, Luxembourg is world-renowned for maintaining top-tier financial privacy. The SRL is an entirely independent legal entity, so it can enter into contracts and hold assets in its own name. And while yes, you do have to prepare financial accounts, your shareholder names and those specific account details are simply not accessible to the general public. You maintain absolute discretion. It's so easy to get lost in all the legal data, but the ultimate goal here is peace of mind. Just listen to this private investor from the United States who said, "Offshore protection helped me structure my assets in a way I never thought possible.
professional, discreet, and thorough. That's what this is really about. It's about thorough, discreet professional planning that secures your wealth and lets you sleep at night. Moving on to Section 4, understanding the tax system. Let's pivot to the hard numbers. Now, keep in mind that territorial system advantage we just went over, foreign-sourced income is largely shielded. But what happens if you actually do generate taxable income locally?
Now, what's really interesting about these numbers is how Luxembourg sets up its sliding scale for locally generated income. So, if your taxable income is under 175,000 euros, your corporate tax rate is a flat 15%. If you land between 175,000 and just over 200,000 euros, you're paying a base of 26,250 euros plus 31% on whatever falls above that 175K mark. And finally, if you're pulling in over 201,000 euros locally, the rate settles at an overall 17%. To make sure you have the complete, unvarnished picture, there are a few supplementary taxes to keep on your radar. There's a 7% solidarity surtax applied to your corporate tax amount. And depending on what exactly your local operations look like, standard property, net wealth, business, and VAT taxes might also apply. But remember, Luxembourg also has a massive network of double taxation treaties globally, ensuring you're not getting taxed twice on the same revenue. A super common question with offshore structuring is about audits. So every SARL has to file standard financial statements within 7 months of the financial year end. However, mandatory statutory audits, those only kick in for massive operations. You have to hit at least 2 of these thresholds for 2 consecutive years: an 8.8 million euro net turnover, a 4.4 million euro balance sheet, or an average of 50 or more full-time employees. If you're operating below those huge numbers, your reporting stays very streamlined. Okay, Section 5, requirements for incorporation. We've covered the what and the why, so let's shift to the highly actionable how-to phase of this explainer. How easily can you actually set this up? Honestly, the speed of this process is just phenomenal. Establishing a premium Luxembourg SARL structure can be completely wrapped up in as little as 1 to 2 days once your documents are prepped. I mean, you do not have to wait months to start protecting your assets.
Let's move to this process and see how it builds, because it's a surprisingly straightforward incorporation checklist. First, you pick a unique name ending in SARL or GmbH. Second, you draft the Articles of Association, and you can actually do this in English, French, or German, which is extremely convenient. Third, you detail your capital, your purpose, and the shareholder identities in that document. And finally, you just file it with the Trade and Companies Register, known as the RCS. That is the whole shebang.
Now, if waiting 1 or 2 days is somehow still too long, or maybe you just need an immediate structure deployed for a fast-moving transaction, shelf companies are absolutely an option here. They are pre-registered and available for immediate acquisition, giving you instant access to a fully formed entity that is ready to operate right this second. Which brings us to our final thought for today's explainer. We've seen how the Luxembourg SARL offers this incredible limited liability, strict financial privacy, really simple incorporation, and incredibly favorable offshore tax conditions. So the question you really need to ask yourself today is this: is your business currently structured for global protection, or are you leaving your hard-earned assets vulnerable? Leveraging international structures like the SARL isn't just a game for massive corporations. It's an absolutely vital strategy for anyone looking to secure their financial future globally. Think globally and protect your assets. Catch you next time.